The markets are still going down. The crypto markets, the S&P 500, the Dow, the other indexes. Actually, I'm gonna go and show you. So here's the S&P 500's performance so far for the year. They're down about 9.5% year to date. Now, we all know that they were up about 27% to end the year off last year. It's only been about 3 weeks, so they're obviously trending downwards since then. The New York Stock Exchange looks pretty similar, a little bit less, but they're still down by 4.7% so far for the year. And if we look at the Dow Jones, pretty similar. They're also down about 7%. So a little different rates, but everything's still trending downwards. Now, if we look at the Nasdaq, which we've talked about pretty recently, same thing, they're trending downwards, just significantly more than the other indexes are. So they're down about 14% so far in the year, the last 3 weeks. And we kind of want to look into why that is. Why is the Nasdaq down more than the other indexes are so far? So in just a second, Dennis and I are actually going to sit down and talk about all this together and our thoughts. But first, we want to break down what all these different acronyms mean. The NYSE, the Dow, the Nasdaq, and the S&P. So if we start from the top, there's 2 major exchanges in the United States, and those are the New York Stock Exchange and the Nasdaq. The exchanges are basically just this place where you can go to buy and sell different stocks and funds. So if you're a company looking to sell your stock in the United States, you're going to most likely pick between either the New York Stock Exchange or the Nasdaq. Now, there's also major indexes that are also used to see how the market's doing. 2 of the big ones are the S&P 500, like we were mentioning before. This one tracks the 500 largest companies in the United States. And then another one that's always referenced is the Dow Jones. The Dow Jones is actually a collection of 30 of the largest companies in the US based on a specific set of criteria that they have. Now, what's unique about the New York Stock Exchange and the Nasdaq themselves is that in addition to them being exchanges, like I just explained, they also have indexes that track the performance of all the companies on that exchange. So those are all the places that are the biggest indicators of how this biggest global market in the world is doing, but what makes them different from each other?
All right, so if people want to know how the markets are doing, how they're performing, they'll look at everything that Steph just mentioned, but more specifically, they'll look at the Nasdaq, the S&P 500, and the Dow. Now, they all perform a little bit differently from one another because of what's actually inside of them, so the companies that they have. So if we take a look at the Nasdaq, what you'll notice is that there's a lot of the big tech companies and a lot of growth stocks. So usually if you're looking at the Nasdaq, it's really a good gauge of how the tech market in particular is performing. If we move over to the S&P 500, this one's obviously a big one, but it covers a lot of the companies that most investors already have or own a piece of within their portfolios. And the reason being is because the S&P covers about 80% of the total US stock market. So obviously another big one. Now, if we move over to the Dow, what you'll notice right away is that this one's a lot smaller. So a lot of the companies that you're going to have here, it's going to have a few of the biggest companies that cover most industries. Now, they all perform at different rates because they're full of a bunch of different stocks and companies. So like we said before, the Nasdaq is full of a bunch of tech stocks. The S&P 500 is pretty spread across the board. And then the Dow only has 30 companies. What's interesting though is that on top of that, they're also weighted differently. So the Nasdaq and the S&P, they're market cap weighted, meaning that companies like, let's say, Apple and Amazon that are really, really big companies and are worth more are actually weighted higher within the index than, let's say, companies like Dollar Tree and Best Buy, for example. Now, the Dow, on the other hand, is actually price weighted. So basically what that means is that it's no longer about valuation or how much a company is actually worth. It's actually strictly about how much its shares are selling for on the market. So, for example, let's look at Tesla. Tesla trades for like $900 a share, while Apple trades for only about $150, $160 a share. Now, Apple is actually worth more and has a higher valuation than Tesla is because of the number of shares that it has out there for people to buy. If we take a look at the Dow again, you'll see that Apple's in here. Let's say fictitiously, right? Tesla is now in the Dow. Tesla would actually be weighted higher based on its price being higher than Apple's than Apple would. So what that does and what that means is that Tesla's performance would actually impact the Dow Jones index more than Apple would. But, let's get into that. All right, so now that we're here together, we kind of want to go over what the inspiration behind this actual video was. And funny enough, it stemmed from this conversation that I was having with my dad. So basically, I helped him get out of these mutual funds that he'd been investing in for years. And what's funny is that now with his new portfolio, he now had everything at the palm of his hands, right? He had the apps on his phone, so he now had access to just check every single day. Whereas before with the bank, he didn't even know what the performance of his mutual funds were.
It's kind of funny because with the apps and the lower fee options, part of the really big positive side is the transparency. But with transparency, you also need to have the restraint to not look at everything every day. It's kind of like ignorance was bliss before, but not worth the high fees.
Yeah, and you know what's interesting is that now with his new portfolio, it was a broad market portfolio. So it was funny. So he's now checking every single day, and he messages me and says, you know, what's going on with my portfolio? Everything is down. You know, maybe it was down by like, I don't know, like 0.5% or a couple percent. So it wasn't a major impact, but obviously, you know, with his money, he was freaking out. So me and him are in the car one day, and he says to me, you know, I was looking at all these other indexes, like the Dow Jones, right? Randomly mentions the Dow Jones, which kind of brought up this whole conversation around what are these indexes and do people really understand them? You know, I'm sure my dad had heard of the Dow Jones, you know, on the news and, you know, for years and years and years, but do we really know what they are and what they stand for? And does it make sense to compare, you know, an index like the Dow Jones to your specific portfolio?
Yeah, and it's interesting too because we wonder sometimes like what makes people panic so much. But when you look at like right now, the markets have been going up and down every single day. Yesterday alone, it was up and down throughout the day. And so it makes you panic, especially when you're hearing all these terms floating out like the S&P 500, the Dow Jones, which are two completely different indexes. But you compare both of them to your personal portfolio, which often doesn't make sense, and you start to freak out. Like neither of us are invested completely in U.S. equities to begin with, and all of those different indexes we mentioned are the U.S. indexes. The U.S.
U.S. specific, yeah.
Yeah, which it does make sense for all of our Canadian viewers that sometimes wonder why we reference the U.S. indexes. It's because that they impact the entire global economy. Like everyone from every country is going to also take a look at the U.S. indexes.
Yeah.
And so, but it doesn't mean that your whole portfolio is invested in U.S. equities. So for us, we have global diversification too. So we can't just look at the S&P or the Dow or the Nasdaq, any of them, to compare to our portfolios.
Yeah, and it does give you, you know, a good gauge, obviously, of how how all markets are performing, just because, you know, the U.S. I believe accounts for almost like 50% of global, you know, market value, right? So really big economy. But at the end of the day, you know, if we're looking at, for example, the Dow Jones, something that's price weighted, do we really understand what that means, right? And, you know, the Dow we were talking about earlier has just 30 companies. Does it make sense to compare your this index that has 30 companies versus your investment portfolio that probably has thousands of companies? Does it really make sense?
That's a good point too. So like that's why we really wanted to go over what these different indexes are and how different they are. But on top of that, in addition to like not comparing those to your portfolio, the other piece is that if you're a long-term investor, and you guys have heard us say this before, it's gonna be the main message. Hopefully you are. But if you're a long-term investor, in addition to not comparing directly all these indexes to your portfolio, it also just doesn't matter what your short-term results are as long as you know you're invested for something that historically is going to do well in the long term. Like if I'm investing right now, it feels like investing for 1 year is a long time because that's the entirety of what I'm going through, but that's super short-term compared to 30 years down the road when I'm actually planning on using any of my investments.
Yeah, and what's funny is that we just got a bunch of comments right now with people kind of freaking out on what's been going on throughout the week and the volatility. Once again, at the end of the day, we're looking at this as, you know, business as usual, or it's a potential buying opportunity where you're purchasing things that you already believed in, right? Like
that's a good point. Like we look at the performance of our portfolios right now for our videos and to share with you guys, and also sometimes it's good to look at your own in general because you can learn from it. But you shouldn't be looking at the result right now and thinking you want it to be higher or whatever, because over the course of investing long term, it's going to go down and it's going to go up, and it's averaging out to an overall positive result.
Which is a huge mental shift, right? Understanding that there's going to be, just like how you were happy that the markets were up 28% this past year.
Yeah.
You know, you need to be just as happy when they're down 28% because, you know, that's a potential buying opportunity, right? Like,
great point.
You know?
That's a good way to word it. That's the big mental shift. And we heard something recently that made that click too, is the fact that if you are investing for the long term, the lower the price is, the better it is to buy. Right now, we're planning on buying and investing heavily in equities for the next few decades. So when prices are low, that's actually a more positive thing than when they're high. Because when they're high, well, we're not capitalizing on that return right now. We're not cashing out any of our investments. And if you're investing for the long term, so a lower market actually is more opportunity to buy, and that's a more positive thing in the long run for our portfolios.
Yeah. I agree.
Keeping it simple with that. So that's the main message we wanted to leave you guys with. Hopefully you learned a bit more about what the different indexes are. I think that's really important to still learn. That's the best way to know that you don't have to compare it to your own stuff, is to understand what it is and what it's comprised of. So that's a good starting point. And overall, no panicking. We're still good, even though the markets are going up and down. We're going to keep talking about it. And even later this week, we're going to do another little market update.
Yeah. We'll see you guys on Friday for a quick take. I guess that kind of wraps things up. As usual, like the video down below, subscribe right over there in Steph's corner, and yeah, we'll see you on Friday, and let's go.
Let's go.